Emerging markets tend to orbit around the US Federal Reserve, but for investors in local currency bonds from Sao Paulo to Jakarta to Warsaw this decade, the Fed has been less than a warming agency. Its influence has more often been that of a cold and punitive planet. In every year this decade, emerging market bonds denominated in local currencies have underperformed EM debt priced in US dollars. At times, such as during 2015, the impact of a strong dollar supported by the Fed has been intensely painful. The dark blue bars on the chart show the years in which emerging market bonds denominated in hard currencies have outperformed those bonds priced in local currencies. The light blue shows the years in which local currency bonds have outperformed. As you can see, this year marks the first time since 2010 that local currency bonds are outstripping their counterparts priced in US dollars. In fact, EM local currency bonds have become one of the best performing asset classes anywhere, posting year-to-date returns of 12.7%, according to the JP Morgan EM Government Bond Index. This is mainly because when the US dollar is thought likely to remain weak against emerging market currencies, investors feel more comfortable with buying assets in Brazil, Poland, Indonesia, and several other places in the EM world. But the question now is, how long can this last? Some people are nervous as the US Fed prepares to hold its annual Jackson Hole Symposium on Friday. Although Janet Yellen, the Fed's chair, has said that the scaling back of US quantitative easing will be the policy equivalent of watching paint dry, investors will be watching carefully for any sign that Ms. Yellen might accelerate the timetable towards US monetary tightening. If such signs do occur, then the Fed's recently sunny demeanor towards emerging markets could turn cold again, sending chills rippling through the EM local currency bond market and making it harder for emerging market economies to finance corporate expansion, infrastructure, and other investments.